One of the top questions I get, and probably every single mortgage broker that's watching this, is should I pay my mortgage off early? Should I repay my mortgage early? Should I make additional repayments to my mortgage? I'm going to answer that question. And spoiler alert, it's probably a little bit anticlimactic because I answer this question all the time, and I think people get a little bit frustrated when I give them the definitive answer. Make sure you watch all the way to the end because I will be answering the question and giving some additional guidance on mortgages. So, should you repay your mortgage early? If you've talked to anyone that has repaid their mortgage, they will tell you it's one of the best things that they ever did. But today, I'm going to give you a balanced overview of the answer to the question, and you'll realize that you actually already know the answer because the answer is pretty obvious. My name is Anthony Lindsay, and I've been in finance for over 30 years. I've done debt collection, wealth management, and lending. Why is that important? Because I'm going to give you a balanced view without my personal feelings. I'm just going to give you the pros and the cons. Today, we're talking and answering the questions, should I repay my mortgage early? So let's just start by saying, listen, as with anything with finance, there is not a one size fits all. It's always going to be dependent on your personal circumstances. That's why I'm not here to give financial advice, legal advice, or replace a conversation with a qualified professional who understands your specific circumstances and, more importantly, understands what your goals are in life for you and your family. So we'll go through the pros and the cons. So let's first start with the pros. So I always like to end with the cons because I want to leave you with the negative side of anything that maybe you think is all positive. So the first pro is peace of mind. Knowing that you're not paying a mortgage payment every month can be liberating. I know people that actually have parties when they make their last mortgage payment. So you do have that peace of mind. The other thing is increased cash flow. So the money you were paying out, you will now be able to use on other things. You might be able to save, etc. And lastly, it's low risk. And we're gonna look at a video now that's going to go through these and some other points, and then I'm gonna comment on my view of what's being said. I think sometimes hearing the same thing from different voices with different nuances is useful.
And before I get into numbers, I'll show you some numbers as we go through this today. But before I do, let's look at the broad pros and the broad cons, because there's two sides to every coin, of paying off your mortgage early. The pros are a guaranteed return, because you don't pay tax on saving money. The other pro is that that return is tax-free. There's the peace.
Now, both of those items, so a guaranteed return, obviously nothing in life is guaranteed. And also around the tax-free return, this is something that you'd want to speak to an accountant about. So it's not a layup, it's not in the bag, but broadly speaking, these are two benefits of paying off your mortgage early.
Of mind. Priceless, one could say. 80% of people who have no mortgage feel much happier than those of others with mortgages. There is the increased cash flow earlier, because as soon as you've paid off the mortgage, the money you were paying on the mortgage is now available for lifestyle.
Now I'm going to talk about that. A lot of people talk about increased cash flow, and that's a really positive thing for some people. I remember during the crash of 2008, I had a neighbor who had a mortgage. And when they reduced the interest rate and his mortgage went down, so his monthly repayments went down, he had an increased cash flow. What do you think he did with that extra money? Did he save it? Did he make additional payments on his mortgage like a lot of people ask me? No. He went out and bought a Mercedes Benz. So you will see an increased cash flow. So you would have more money in your pocket. But you have to question, are you disciplined enough to manage that money wisely? So the increased cash flow is a pro, but it can also be a con.
And that means financial freedom that we talk about being available that much earlier. And there's minimal risk because the returns are all but guaranteed. Of course, interest rate risk exists, and if you're on a variable rate, they can change either up or down. But there's very little risk when you decide to repay a mortgage early or accelerate payments. But as I say,
Okay, so those are some of the pros. So you're going to have peace of mind. You're going to know that you don't have this huge repayment every month, or maybe your repayments weren't that high. You're going to have increased cash flow. So now instead of that money going to a bank every month out of your bank account from your salary, it is now staying in your bank account. Maybe. And there's low risk because if you've paid off your house to a degree, there is low risk because that money is now retained value in your home, which in 9 out of 10 cases, over the passing of time, property values are going to increase. So you might be thinking to yourself, this all sounds great. Why on earth would I not repay my mortgage early? Why would I not want the peace of mind, the relative low risk, the increased cash flow? As with everything, there are ups and there are downs to everything that you will do in finance. So, one of the things that you have to think about is, let's just say you have an extra £50,000 to repay your mortgage, and you use that capital to repay your mortgage. You have to consider the opportunity cost. What if, 6 months from that, you had an opportunity to invest in a sound business? You lose that opportunity. What if there's some properties up north that, because of the renters' right reform bill, landlords are trying to get rid of on the cheap? So it's a great investment, and I'm not suggesting that or giving anyone investment advice, but just think about the opportunity cost. Not having that capital liquid available in your account, there is a risk to that. There's also less diversity. So if you put all of your money into your property, you're not spreading or mitigating the risk. So that means if there are any issues short term in the property market, all of your money is tied up in that property. And what will you realistically do with the money that you're saving? I gave a scenario about a real life experience where I had a neighbor who had the additional income or the additional capital because the repayments on his mortgage went down, and he went out and bought a Mercedes instead of saving that money, or instead of, diversifying or investing. So the thing is, realistically, are you disciplined enough to not have a mortgage payment each month? Are you disciplined enough to be able to do something wise with the income that is now staying in your bank account, as opposed to going out on a mortgage payment? So what we're going to do now is we're going to look at some additional downsides or cons to paying your mortgage early. As I said, there's upsides and downsides, and I just want to answer your question: should you repay your mortgage
and
early?
before I get into numbers, I'll show who have no more available that much need of exists,
Okay,
and if you're
so
repay
here
a
we go.
mortgage early or accelerate payments. But as I say, every coin has an opposite side. What are the cons? The cons include the opportunity cost. What else could you have done with the money? Could you have made more money from an investment return? Could you have got tax relief on that money by investing in a certain manner? The cons are the time value of money, as counterintuitive as it feels, guys. The longer you repay the capital on a mortgage over, the cheaper it is. If you think about paying $10,000 a year in capital over 20 years, the $10,000 you pay in year 20 hasn't got the same value as the $10,000 you paid in year 1, because time value of money has eroded. Inflation has eroded its value. And I suppose the last con is diversification. If you invest the money instead of accelerating the property payments. You're diversifying away from property into other investment assets.
So that's a great point. And again, there are cons or downsides to repaying your mortgage early. So there's an upside, there's a downside. And here's the simple answer: it all comes down to your appetite for risk, what you're trying to do in the long run, and what the other people on the mortgage actually want to do. So, the upside of repaying your mortgage early is that you're going to have that additional income flow each month. One of the downsides is with that additional income flow, you lose the ability to diversify. So, you're going to need to speak to an accountant, speak to your family, and also decide emotionally which one is best for you. I had a client one time that she had about £60,000 in savings. She was looking to purchase her first home. And in going to purchase her first home, she was like, I have £60,000 as a deposit. When I looked at her credit report, she had about £20,000 in debt. Now, it was all being serviced well. She had never missed a payment. She didn't have a high debt to income ratio, relatively speaking. And what I said to her is, well, why don't you pay down or pay off the revolving credit and installment credit that you have? So she could have taken out of that £60,000 deposit that she had, she could have taken £20,000 and paid off one of or all of the different outgoings that she had. And what she told me is also the answer to the question of should you repay your mortgage? She said, I feel so much better knowing and seeing that that money is in my bank account. Even though she was also aware of the fact that what she was paying on interest on servicing the outgoings and servicing the debt that she had, what she was paying out on interest was a lot lower or a lot higher, actually. The interest that she was paying on those loans was a lot higher than the interest that she was getting on the savings. So £60,000 to a lot of people will be a lot of money in savings. And for her, she was like, well, I have it. I can see it. I feel good. I know I can access it if I want to. And I'm getting little or nothing interest. I'm paying my credit cards and my loans well each month, and I'm paying out a high amount of interest. So what she felt and her emotion was overriding the math. As a mortgage broker, it's my job to just point the math out. But ultimately, your emotional drive or your personal circumstances will override quite often the math that is involved in the question, should I repay my mortgage early? Now, I hope that that has answered your question, and you probably knew the answer in the first place. You probably watched videos, you probably understand the pros and cons, but now you need to ask yourself emotionally, which one of those scenarios is best for you? I don't give financial advice and I don't give legal advice, and my videos are not designed to replace speaking to a qualified professional. Make sure you like, subscribe, and share. And if you disagree with anything that I'm saying, or if you have a topic that you'd like for me to discuss, make sure you put that in the comments. Okay, so in this session, I am going to probably say a lot of things that a lot of young people and maybe some parents won't like. I'm going to talk to Gen Z about getting on the property ladder. I'm also going to explain why you should not buy into the hype or the lie that you cannot buy your first home. My advice to Gen Z is stop complaining and start saving. I'm so sick of Gen Z and parents that have Gen Z kids saying it's so hard to get on the property ladder and it's so difficult and this is generation rent. Let me just talk through some math with you. And also, let me speak as a person that's been working in finance for over 30 years and someone who's going to give you impartial guidance, suggestions, and tips. To that end, I've written a book called A Mortgage is a Really Big Loan. I've taken my 30 years of finance experience, both in the US and in the UK, and put it all in a book. Now, this book is not just about mortgages, it's also about just basic finance. So, if you have a young person or someone who is just entering the workforce, just coming out of university, this is a fantastic book. It's also a really good resource if you're someone that's recently relocated to the UK or someone that's been in the UK forever and you just feel uncomfortable asking certain questions about finance. A Mortgage is a Really Big Loan is available on Amazon, and I'd appreciate your support. So, getting a mortgage as a Gen Z or at any age, it's not rocket science. It's simple math. You may not like me for saying this because I take the emotion out of it, but it's all made up of your income, your credit, and your deposit, or your credit, your income, and your deposit. So we'll go through that and I will debunk a lot of myths. But we'll also look at the fact that you need a plan. If you're a Gen Z, you need a plan. You can't expect for money to fall out of the sky and fall into your bank account. You can't live a certain lifestyle and then complain that you can't get on the property ladder. Another thing that I want to say, I hear it all the time. It was so easy for my parents to get a house because, as the multiple of their income, it was so much lower. Facts, 100% true. But the other side of that coin is your parents and my parents and grandparents weren't getting the equivalent of 80,000 pounds a year jobs. They were not, when they first came to the UK during Windrush or earlier generations, they weren't, for the most part. Some people were coming over as skilled doctors, etc. But for the most part, they were coming and, like my grandmother, working on the bus or cleaning houses, or so even as a multiple of their income, although it was more attainable, it was a lot harder. It was a lot harder because they didn't have the internet. They couldn't just log on and say, how do I find a house? They couldn't watch videos like this. They had to, as a community, come together and share information. They made huge sacrifices. They didn't buy the equivalent of, if they had them then, £1,000 cell phones. They didn't go on vacation every 3 months. They didn't eat out every day. So, in short, in some ways, yes, it was easier. But for the most part, in this generation, you have more access and more ability to make money. You can go online like I do and sell stuff. I don't sell stuff, but I talk about mortgages. You can have a side hustle. You can do a lot of things that they couldn't do. Keeping in mind, for them to earn money, they had to leave their house every morning, not call in sick. They had to go somewhere and work really hard, usually under conditions that weren't as safe as we have now. So I don't like hearing the position that it was so much easier for my parents, because keep in mind, in that exact same generation there were some people that didn't make the sacrifices to buy a home. The other point that I want to make is you'll have to sacrifice. All right, you have to sacrifice. You may need to experience what we call, as older people, delayed gratification. So that means you can't go out to eat at Nando's every single week. You can't, as I said, go on vacation every 3, 4 months. You can't, just spend money like there's no tomorrow and then complain that you can't save for a deposit. If you're in Gen Z, this is my challenge to you. If you feel you cannot get a mortgage, and you have not talked to a mortgage advisor that can actually talk you through the process, make sure you reach out to me, because I will do a free mortgage capacity report and tell you how much you do qualify for and how much you can get. And in the delayed gratification, that's another point. Most of your parents and most of our parents and grandparents did not buy their forever home as their first home. Many people had to buy that smaller unit or smaller house, and then they sold that and built up and built up and built up. So I talk to a lot of young people that are looking to buy their first home, and I think that's honorable, and they quite often have done all the right things, but they won't sacrifice the size or location of that first home because they feel, because they have done the right things, they're entitled to having the 3-bedroom Victorian in zone one. It's very rare that I can't get someone a mortgage. It's very rare. Usually the issue is the amount of mortgage that I can get for them. And we're going to go through a few things to help you understand how you get a mortgage. So the first thing is going to be your income. Take the emotion out of it. Let's just do the math. So we're going to look at your employment status. Are you employed full-time, part-time? Are you a contractor? What is your employment status? Are you on probation? Not with the government, not with the penal system, but are you on probation? Did you just start the job? What does HMRC say your income is? So we'll need to see your P60, that we can estimate how much you made last year, but also just understanding from your contract how much your salary actually is. And if you have a second income, as I said, it's a great way of increasing your affordability by increasing your income. That means maybe you have to work a second job. Maybe you have to sacrifice some of your personal time in order to increase your income in order to be able to afford the home you want. And this will also help you towards your deposit. So, what about the gig economy? What about going on Fiverr or one of these platforms, Uber driver, just something that you can increase your income, but make sure that if you are doing a side hustle, you set it up as a business properly. Make sure you're paying the appropriate taxes. I'm not here to give tax advice, and I don't give legal advice. And the information that I give is not to replace speaking to a qualified professional, but I just want to talk you through how you are going to be able to get a mortgage. Here's a quick calculation. And for all you mortgage brokers and accountants, you can put your comments in the comments, but this is just a rule of thumb. So please don't take this as the one scenario for everybody. But if you use this formula, you will find it useful to get a better feel for how much of a mortgage you will qualify for. So the first thing you want to do is take your actual guaranteed salary. So that's how much you're guaranteed to make. So if you're off work sick and you don't go in, you're still guaranteed an amount. You take your actual annual salary and multiply it by 4. So let's just say you are on 25,000 a year, and you multiply that by 4. That's 100,000. Roughly speaking, you will qualify for a mortgage of 100,000. That's the mortgage. That is not the house price. So how do you get the house price? You take the amount of mortgage that you qualify for. In this scenario, it's 100,000, and you add your deposit. So let's just say you have rich parents and they're going to give you 50,000 pounds. You take the 100,000 pound mortgage that you qualify for based on a 25,000 pound income, and you add the deposit. So 100,000 plus 50,000 is 150,000. That's how you come up with roughly the house price that you can purchase. So remember, it's a combination of the amount of mortgage you qualify for. So the 100,000, which is 25 times 4, plus the deposit. For the sake of this scenario, I'm saying don't think about loan to valuation. That's a discussion to have based on your criteria with your mortgage broker. But I like to just kind of manage people's expectations because, quite honestly, people often come in with a grossly out of real world view of how much they can qualify for a mortgage. Now, this is not an exact scientific calculation, but I guarantee you, if you use this as a base, it will be closer in most cases to what you qualify for before you speak to a broker. The other thing is, as a young person, if you're complaining that you can't get on the property ladder and you're not saving, then you're not serious. So stop complaining, start saving. And if you are planning on buying within the next 5 years, then maybe you should consider a lifetime ISA. I've done a lot of videos on lifetime ISAs. It's not for everyone, and it's certainly not for you if you're planning on buying within the next couple of months, because the lifetime ISA would have to be open for more than 12 months. But make sure you do your research. There's some great benefits to a lifetime ISA. But if you get that lifetime ISA and it's not the right product for you and you use it for the wrong purposes, meaning you try to withdraw or you're not using it for your first home or as a pension pot, there are huge penalties. So make sure that you do your research. So let's talk about the deposit, because remember, getting a mortgage is down to three things: your credit, your income, and your deposit. So let's look at the deposit side of things. So, does the money make sense? What I mean by that is where the money came from that is now your deposit. Does it make sense? Are you working in retail making, 23,000 a year, and every month there's 6,000 pounds going into your account? That doesn't make sense. So make sure that your funds are coming from legitimate sources. Make sure it's easily tracked. Make sure it's all on the level. The other thing is, can it be tracked? So again, what you want to do is make sure that when you get your salary each month, you've set up a high interest savings account. I'd recommend you go to Money Savings Expert and do your research. You transfer the money or you put the money directly into a savings account that's giving you a high interest rate. This way, the bank can see, yep, Joe got paid on the 15th. He transferred some money into his ABC savings account, and now this is the money that he has towards his deposit. Also considered gifted deposit. So a gifted deposit is, let's just say you have a family member or a parent that is giving you some money towards your deposit. The thing to consider is it has to be a gift and not a loan. So if they're saying, well, you have to pay me back, then it's not a gift, it's a loan. And the banks will then take that out of your affordability, meaning they're giving you 50,000, but you have to pay it back. They're going to say, well, how much are you paying back per month? The other thing about gifted deposits is for some lenders and some products, the lender will not allow the full deposit for the new purchase to come from a gifted deposit. So make sure you speak to a mortgage advisor that can find you the right product for you. As I said, I don't give financial advice or legal advice, and you should always speak directly to a professional. There are some other ways to get on the property ladder. So concessionary mortgages. So that would be maybe you're renting currently and your landlord is going to sell you the property for less. Joint borrower, sole proprietor. Make sure you check my videos because I've done a couple of extensive videos on joint borrower, sole proprietor. So what is that? A joint borrower, sole proprietor mortgage is one where maybe you're buying with a sibling. So you're buying the first home with a sibling, maybe a friend, because some lenders will allow you to use a friend or sibling. They don't have to be on the actual deed. So yes, they're helping you towards the purchase and their income is going toward your affordability, but they're not on the deed, so they don't actually own it. Now, the caveat to that is, although they're not on the deed, they still have a legal responsibility towards the payments. So that means if you don't pay, they have to. So if you're considering talking to your parents about doing a joint borrower, sole proprietor mortgage, because maybe they have a home that it was the family home and it's already paid off and they're both still working. So it usually works if your parents are around 50. As they get older, it becomes a little bit more difficult because of the term on the mortgage. The term is always going to be based on the oldest person. So if your parents, like mine, are way past retirement, it may be a little bit problematic. But a joint borrower, sole proprietor mortgage is fantastic if maybe you're buying with a sibling or a friend who wants to help you out. If it's a parent, make sure that you're looking at the age, but your mortgage broker will talk you through that. Also, maybe a parent wants to gift you some equity, or maybe they want to take some equity out of their home to help you. These are all things to consider. But I think one of the key things that you can do as a Gen Z to get on the property ladder is firstly, stop just looking on TikTok. Actually talk to a mortgage broker who will understand your circumstances, who is licensed. The reason why I keep stressing this is because you do have a lot of people on social media. I'm not knocking it, I'm here, but you have a lot of people that aren't licensed professionals, that aren't brokers. They're just giving you general information that the spirit of what they're saying may be correct, but it might not apply to you. And worst case scenario, you can get yourself in a lot of trouble financially and potentially legally if you do the wrong thing. So make sure you're always doing the right thing. You're doing things in a way that you are complying with the terms of your mortgage. You're not looking for get rich quick, and you exercise just a little bit of delayed gratification. If you're Gen Z, you can purchase a home. Don't let anyone fool you and say that it's impossible. It will take some discipline, it will take some delayed gratification, and you will need to save and work hard. So you need to look at your credit. So make sure that you're managing your credit well. Make sure you're not co-signing for people, because if they stop paying, that's going to mess up your credit. Make sure you check your credit report at checkmyfile.co.uk or .com at least once a year, but certainly every 6 months. And I would always recommend that you speak to a mortgage broker 6 months before you think you're ready, or it may be 4 years before you think you're ready. I have a lot of young people when I go out and speak at events that will book an appointment with me, and they're not ready now. They're just starting their job. But I'm able to then give them a blueprint, some guidance, answer their questions, and give them some real advice from a qualified professional based on their circumstances, rather than them looking at TikTok influencers who quite often don't make any money from mortgages or the things that they talk about. They make their money by being influencers on TikTok. And the quickest way to build a following on TikTok is to say sensational things. I'll give you an example. I spoke to a gentleman the other day who watched one of my videos and then booked an appointment. He was talking about his credit. He had a credit bump, and he was saying that he had seen a video about why he should not pay off this outstanding debt. There are some provisions and schemes that legitimately you can do that. But what I explained to him, because the debt was so small, it was less than £200. He was trying to, kind of wiggle his way out of it. I'm like, it's costing you more on your mortgage. So sometimes you see these things online, and the sensational stuff that gets all the clicks is just for the sake of getting clicks. I'm not demeaning anyone that does that, but I'm just saying, take that information, speak to a trusted mortgage advisor, and stop believing the lies and the myths and the well-intentioned things that your barber tells you, or a guy that has different circumstances than you do, what they tell you, and will speak over you and make you feel like you can't get a mortgage, or you have to buy your first home that's your forever home and you're not going to compromise. And don't forget, this March 21st, or upcoming March 21st, 2026, in London, we're doing our 6th annual East London Business and Property Expo. So that's the East London Business and Property Expo. Meet mortgage brokers, meet lenders, meet specialist lenders, learn about property and finance from people that you're actually speaking directly to. Registration is free, but the master classes cost money. So if you are interested in maybe going into property investing and you want to speak to real professionals that aren't just there to sell courses or to get you to give them money with absolutely no risk to them, if you want to actually get answers from a range of mortgage brokers, investors, and property experts in a nuanced way, in an open discussion that you can ask your specific questions, make sure you attend the East London Property Expo. Each year we have over 600 people. We'd love to see you there. I'd love to see you there. We're going to have a Q&A, depending on when you watch this video, you may have missed it, but we're going to have a Q&A session on the August 13th. So you can log in, you can ask questions, but we have Q&A sessions every month that if you're interested in property, in attending the event, you can find out. So make sure you check that out. Are you a vanilla client? So, what is a vanilla client? Most of the time, the headline rates that you see that lenders offer is for what they call vanilla clients. So I'm quickly going to describe what a vanilla client is that you can know if you match this criteria, because in that sense, then a lot of the things that you see broadcast as far as rates and as far as criteria, you would qualify for. So first and foremost, a vanilla client is someone who has a UK passport. That's not to say if you don't have a UK passport, you can't get a mortgage. It just means that this is what most of the products that are on the market will definitely match the criteria, or you'll match the criteria for if you look like this. UK passport, no credit issues ever. That means no credit issues ever. That means you've never had a credit issue. That means you've never missed a payment, never had a late payment, never had a CCJ, never had a default, never had anything like that. Okay, so it's not just about your credit score, because a lot of people obsess about credit score. It's about your credit profile. So that means anytime you've had finance, you've always paid it well, paid it off, and kept it at a low overall balance. The other thing is a good deposit. I often hear people talk about 5% deposit, 10% deposit, 15% deposit. Get that number out of your mind, and let's just start talking about how much liquid cash you have in your savings account that you can demonstrate you have, and you can demonstrate how you built it up. So a good deposit for most people is going to be quite a lot as a percentage, even though I said to ignore that. That would probably be about 15 to 20% of the purchase price. So the reason why I caution people about talking around um, percentages is because percentages are math. And one of the first questions that I ask people when I do my initial assessment with them is, how much does the house you'd want to live in cost? I ask it that way because quite often, if you say, well, how much does a house cost, or how much can you get a house for? They'll be, oh, from 400 to 480,000 pounds, because we're in London. Now, the difference between a 400,000 pound house and a 480,000 pound house is huge. But more importantly, the deposit amount, even if you're talking about a percentage, is huge. So if you're buying a 400,000 pound house, and let's just say you have a 10,000 pound deposit, that's 40,000 pounds. If you then find a house that's 480,000, then that's 48,000 pounds. That's why it's important. Always, always, always tell your broker how much you have in savings for your deposit. Don't tell us a percentage, tell us an actual physical amount. We're not here to get you to spend more money than you want, but by us knowing that, we can advise you better. So a vanilla client, UK passport, no credit issues ever, full-time employed PAYE, and you're purchasing at a low multiple of your income. So full-time employee, the reason why that is more a vanilla client, because if you're a contractor, if you're part-time, 0 hours contract, if you're paid through an umbrella company, there are some lenders that won't lend based on those criteria. There are lots that will, but you're not really a vanilla client at that point. And the income multiplier, I speak about that frequently. Please, 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 please don't shout at me in the comments and say, yeah, but some lenders lend at 4.25 or 5 or 5.5 or 7. From the perspective of managing your expectations, it's best if we go into the conversation with the 4 times multiplier, and then maybe based on your profession, how old you are, and the other circumstances, we can get into that. But if you don't meet this criteria, then you're probably like most people. You're not a vanilla client, but there is hope. You don't have to worry. You can still get a mortgage. It might just mean that we have to look at a different range of lenders. So potentially you can't just go to, the high street lender that you were potentially considering. All right, let's talk through the mortgage process. I do this all the time, and this is really important because the mortgage process is the mortgage process. This is the process that you will follow in order to get a mortgage. And let's be honest, when you are looking to buy a house, you're looking to get a home. You're not looking to get a mortgage. A mortgage is a necessary part of getting the home for you and your family. So let's quickly go through this. Everyone thinks they understand, but I do find that when I'm actually working with people, as we go through the process, people have questions, and that's fantastic. So let's make sure that you fully understand the process. So, step one, you're going to do an affordability assessment. So, that means you're going to speak to a mortgage broker who's going to ask you questions about your income, your outgoing, your credit, all of the things that they can assess how much money you actually make and can prove you make, as well as how much money you are paying out. And this is going to be determined by looking at your credit report and your bank statements. Your bank statements and your credit report will paint a picture of how you manage your finances. As I always say, make sure you're open and honest with your mortgage broker. We're here to help you. We're not here to trip you up. Just like banks want to lend you money. So the more information you give your broker from the very first conversation, the better it is, because they'll be able to weed out the people that won't lend to you and narrow in on the lenders that will. So mortgage affordability assessment, that's an open, honest conversation with your broker. He'll then be able to take that information and get you an agreement in principle. An agreement in principle is a required part of the process, because when you go to make an offer on a property, the estate agent 9 times out of 10 is going to ask you for an agreement in principle. Now, you notice the first step in this process is for you to get an affordability assessment. Quite often, I find that people go on Zoopla or Rightmove and then they do that little calculator on there. Never do that. Always speak to a broker, because if you go back to what I was saying before, usually that's based on a vanilla client. And usually it will give you a higher amount than you actually qualify for, because it's not taking into account your outgoings. So don't use the Zoopla or Rightmove or these online calculators. Always have a mortgage broker do it for you, because they'll be able to do the right calculation, get you closer to where you need to be. That will produce an agreement in principle. An agreement in principle is not a contract. It's not a promise 100% that the lender will lend. It's just a guide, unless you work with our firm. Our firm, we do our due diligence up front. So we would, before we would do an agreement in principle for you, we're going to validate everything that you tell us. So there's an expression in the States: trust, but verify. So this means we're going to go through your bank statement, go through your pay slip, go through your credit report, that the assessment that we make for the agreement in principle that we produce is more likely to convert into a mortgage offer. So once you have the agreement in principle, you've made an offer on the property has been accepted, the bank will do a valuation. And this is a valuation and not a survey. This is a valuation and not a survey. What's the difference? A valuation is for the bank. The bank will assess how much they think that property is worth. That's what counts, because they're the ones lending the money. So a valuation is done by the bank, for the bank to assess how much they think the property is worth. A survey, on the other hand, is something that sometimes buyers will do to assess if there are any meaningful issues with the property. So they want to know if there are meaningful issues with the property that might cost them money or might surprise them. So you will go to a RICS surveyor, purchase that survey, they'll come out. The thing to keep in mind, let's just say you pay £400 for that survey, that's for you. And if you find that because of that survey, there's issues with the property, that means you're not going to buy the property, you don't get a refund on the survey, okay? Because you're paying for the service. Now, what will happen quite often is people will use the information from the survey to go back to the seller or estate agent, say, well, there's some issues here, it's going to cost me X amount, and you can renegotiate the deal. They don't have to take that as gospel, and they don't even have to renegotiate the deal. So understand the difference between a valuation and a survey. They're two completely different things. The valuation is for the bank. So the valuation is for the bank. Sometimes you'll pay the bank to do that valuation. Sometimes it's free as part of the product. The survey is for you, the buyer. You pay for the service, not for the outcome. And as part of the valuation, they're going to do the underwriting. So the lender is going to underwrite the loan. So this is when they're going to ask me as the mortgage broker to produce the bank statements, the pay slips, anything that is they need to know or drill down on in order for them to make you a mortgage offer, which is where we need to be. So some of the things to consider with the underwriting is, and this has happened recently, if you have more than one job and you have a second job, so you have a primary job and a second job, how long have you been at that second job? So if it's something that's short term, they may not include that additional income. But more importantly, is there a provision in your primary employment that prevents you or requires you to have permission to work a second job? So underwriting will go through lots of different things. I've seen deals underwritten in 5 business days. I've seen deals underwritten in 2 weeks. It's usually determined by how quick you are in responding to the request from the broker. Now, because you work with me, what will happen is I'll have 90% of the things in advance. This is why at the agreement in principle stage, we'll ask for the items in advance. But sometimes lenders will ask for things that we haven't asked you for, because we're only able to ask you for the things that we know that we need and we know that the lender will need. So you'll go from agreement in principle to underwriting. Once the underwriting is done, they will give you a mortgage offer. The mortgage offer is actually what you need. So I want to stress this fact around agreement in principles, because a lot of my clients come to me and they say, my broker got me an agreement in principle, or my bank gave me an agreement in principle. And when I've actually gone to make my purchase, they've said that they won't lend to me. A thing to highlight and put on the sticky side of your mind, and a thing to consider, is that the agreement in principle is about you and your circumstance. The offer is about you and your circumstance plus the property. So you can find that you have an agreement in principle, the lender wants to lend to you, but they're just not happy with that property. That could be because of a lot of reasons. But if you have a solid agreement in principle, meaning your broker has done the due diligence in advance, then you shouldn't get any surprises as far as the offer. And if you've allowed your broker, if they do offer this service, to actually do the negotiation for you, ask questions, speak to the seller, speak to the estate agent, you won't have that nasty surprise of the lender saying that, well, we're happy with you, Mr. Customer, we just don't like this particular product. So once the mortgage offer is in place, for all intents and purposes, a lot of the job of the mortgage broker is done. Probably 95% of my job is done at that point, because once you have the mortgage offer, it goes over to the solicitors. This is why it's important for you to start engaging with solicitors and getting pricing and understanding their service levels before you get to this point. In fact, when we're doing the underwriting and doing the full mortgage application, the lender's going to ask for the name of your solicitor. So in my very first conversation with you, I ask you if you have a solicitor. As we progress, I will introduce you to solicitors, but neither I or the estate agent can require that you work with our solicitor, and the estate agent cannot require that you work with their broker. So you have the mortgage offer. It's now over with the solicitors. The solicitors will talk to each other. They'll go through the deed. They'll go through all of the things. Make sure that when you're selecting a solicitor, you're not selecting a solicitor based solely on price. I've seen it go wrong so many times. People are like, oh, I can save £300 by going to this solicitor that has this dashboard that I can never talk to anyone, never explain any nuances, never actually have a conversation with a human being. That can delay the deal. It can prevent the deal from going through. So always select your solicitor based on price and service. So you now have the underwriting done, you have your mortgage offer, solicitors are talking to each other. The rest of it is just a waiting game. It usually takes about 4 to 6 months to purchase from the moment that you have the mortgage offer. So 4 to 6 months. I'm not saying that to scare you, but I want to manage your expectations. It can be quicker, it can be longer. In that time, you're waiting and your solicitors are communicating with the seller's solicitor. Then you get the exchange date. A thing to keep in note, you determine the exchange date with your solicitor. So you may want to arrange it in a way that you can give the appropriate notice if you're currently renting. But that's going to be between you and your solicitor. Make sure you have a solid conversation with your solicitor about the exchange date and the completion date, and ask lots of questions. You have the right, because you're paying for a service, to fully understand the process. This is not something that I, as a broker, will be able to engage with. You'll need to be talking to your solicitor, which is why I say make sure you select a solicitor based on service and not just price. How do I prepare for a mortgage? Very quickly, what you're going to want to do is make sure that you review your employment contract so you know if you're full time, part time, 0 hours, and you know what your actual annual guaranteed salary is. Tidy up your bank statements. Don't have silly direct debits on there or standing orders. This might also be an opportunity for you to save money, because you might see that you have multiple outgoings that are the same thing. Maybe you have a bank account that offers you a free Netflix account and you're paying for Netflix. Or maybe you're paying an insurance for your phone, but it's actually covered by your content insurance. So review your bank statement, tidy it up, make sure that everything makes sense for your circumstances and your status. Make sure that you check your credit report, check your credit report, check your credit report. Very rare that someone approaches me and we start a mortgage, and when they pull their credit report, they're like, yep, I knew all of that. The only way that ever happens is if they've been checking their credit report regularly. Make sure you check your credit report at least once a year. I'd recommend twice a year. You can go to checkmyfile.com and get your credit report. It is a paid service, but I assure you it's worth it. It does give you the opportunity, especially if you're getting a mortgage, to be able to tidy things up, challenge things in advance of the mortgage application. And just by doing that, you can save yourself quite a bit of money and ensure that you have the most options based on your circumstances. So check your credit report. You're also going to want to maximize your deposit. How do you maximize your deposit? You maximize your deposit by making sure that you're not saving in a low interest savings account. You can go to Money Savings Expert and shop around, do your due diligence, speak to a professional if you need to. But quite often, you will find that high street banks don't have the highest interest rates. If you are a young person and you're not buying within the next 12 months, or if you're anyone actually, and you're not buying within the next 12 months, you might want to consider a LISA or a lifetime ISA. Some people call it ELISA. You can pay in at this moment £4,000 per year, and you'll get £1,000 from the government. Make sure you do your due diligence on that. But make sure you maximize your savings. Don't engage in what I refer to as cultural saving schemes. Make sure that you're always doing things in a way that is traceable, trackable, and is compliant with all UK laws. And you know what I'm going to say now? Make sure you speak to a broker. Your friends, your barber, the guy that you see at the grocery store, all of these experts, unless they're licensed mortgage brokers, they may mean well, but they might be giving you bad advice. Even more so, you're probably not going to want to talk to your barber about your personal circumstances as well as your credit issues. So when your barber is telling you, you can buy a house with zero down, or you only need a 5% deposit, they mean well, but speak to a licensed professional. And you should speak to a broker at least 6 months before you think you're ready, because a lot of the things that you're going to need to do to clean up your credit or clean up your file to make sure you get the very best mortgage that you qualify for, a lot of these things do take time. My name's Anthony Lindsay, and I create these videos so that you can have a nuanced view of the mortgage process. Always remember, if you don't maintain your payments or repayments on your mortgage, your house could be repossessed. I don't do these videos to give or legal or financial advice in that sense. Make sure you speak to a qualified professional who understands your circumstances, your goals, the things that you want for your family, your appetite for risk. All of these things make a huge difference. Don't get your advice from some influencer on TikTok. It's a great place to understand and learn about new concepts, but always speak to a professional. Always be honest. Don't try to skirt around policies or laws. Always get the right mortgage type for what you're actually intending on using the property for, because you want to make sure that your mortgage is appropriate to you, and a good mortgage broker will talk you through the process. And sometimes your mortgage broker will save you from yourself, because if they're an experienced broker, they're going to give you advice based on years of experience. Make sure you like, make sure you comment. If you've heard something in here that you don't think is quite right, please put your comment in there. If there's a topic you'd like for me to discuss, happy to do it. Put that in the comments, and make sure that you book an appointment with me if you are looking to get a mortgage, even if you're not ready right now. I don't charge for the conversation, and I'll always put your needs first. My name is Anthony Lindsay, and I've been in finance for over 30 years, and I'm here to help you get the best mortgage that you qualify for based on your circumstances.